This is great what you're doing, by the way.
My mission is simple, to help you protect your family and keep more of your money. I'm here to help level the playing field for families and those who seek the truth. There's always a new way to make money, but at the end of the day, it's your family's security and your legacy that matter. And I promise to help you protect what's really important to you. Legacy Money starts now. Hey guys, Barry Page with Legacy Money. This is the show that shares the truth about money so you can live more, give more, and leave more. Today we'll be live on YouTube, so go ahead and share this link if you're watching live. If you're watching the recording, thank you for joining us. Also have the live chat going today. And just want to remind you to stay with us through the video. We've got a very special guest today. And we're going to be talking about bank-owned life insurance. So welcome to the program, Tom Kosanda. Tom is he's an expert in the field of bank-owned life insurance. As a matter of fact, he builds these plans. He's a nationally recognized expert. He works with big banks, regional community banks, and he's got a lot to share with us. So, Tom, welcome to the program.
Welcome, Barry. Glad to be here.
Fantastic. Now, I got to give a little backstory on Tom. Tom and I share something in common other than the banking and life insurance. Tom and I, we didn't actually sell together, but we sold books door to door. And boy, it was a lot of fun. Met a lot of people. We've got to get together a couple times here in recent years for funerals and reunions and birthday parties. So it's been a good time. So Tom, you sent me this picture, and I just want to share it so everybody gets an idea. Look at this guy standing there with Ronald Reagan and Sam Moore. Now, was this your first summer? Tell us about that.
No, that was summer about number 4.
Number 4.
I had the number 1 team, and I was one of the top 5 sales guys that year.
That's awesome.
And it was just such a privilege to meet Mr. Reagan. And he was so warm and generous. And, naive of me, I had wool suits that were dark gray. For whatever reason, in November, I'm wearing a polyester blue suit. And it's like, what little did I know about fashion?
Yeah, well, it's black and white, so you can't really tell. Looks, but now that you say that, the leisure suit there with the vest. Look at you, though, man. You're looking.
It wasn't a leisure suit. At least I graduated from leisure suits. That was.
So you were the top dog or the top team, huh?
Exactly.
That is a tremendous feat. That is unreal.
All 10 people that I recruited made it. They all made money. They all came back home positive cash flow with enough to pay for at least a semester of college. And there's still many lifetime friends that came back from 76. So it wasn't only just helping families with what we were offering, but it was literally lifetime friendships.
Absolutely.
And that was one of the best things. And Mr. Moore was such a mentor.
Yes.
Gosh, I love him. Sad that he passed.
Yes. Yes. Well, so the company was Thomas Nelson. They most known for their Bibles, but we sold some other books. I'll show a little bit of one of my summers here. This is my favorite set. I called that the Nelson Family Library. Dropped off a few books at a few houses that summer, and of course that's where we recently saw each other with Mr. Sonny Cruz at his birthday party.
Yeah.
So Sonny was the director there, and boy, that was some good times on the book field. But back to this, so did you get the Triple Crown? Did they have that then?
They did not have the Triple Crown.
So the Triple Crown was take 10 to sales school, wholesale 10,000, and be in the top 10. So I made 2 out of 3 of those a couple times, but it's hard to keep guys in, working during the summertime. And I just want to show you this. I was most proud of this. I don't know if you ever won this Diamond Award, but that
Yep.
was for working 80 hours every single week of the summer, uh, door to door, selling books. And this is another week where I was real proud because I made the top of the varsity vision as an experience. That was in 92 after I came back. But yeah, 80 hours a week we work, 70 to 80 hours. And to get 10 other guys to do that, I mean, how did you do that? How did you convince 10 college kids to go work during the college summers in the heat of the summer on straight commission?
I
How did
got
you
I
do
got
that?
I got a funny story, a couple funny stories.
Tell us.
First one, Barry. When I started, it was only 70 hours. Then it became 72, and after I left, it became 75. So I feel sorry for you guys that had to work 80. we at least got a Sunday off.
Oh,
And,
man.
so that was one aspect to it.
Yeah.
The other aspect to it is when I was recruited in the college dorm, somebody from Southwestern, who was a competing book company,
Yeah.
was asking all these questions. What's your biggest moment, and what's the biggest thrill that you've had in life? And I came back and said, I bought a stock that doubled in price within 3 months. And he never recruited me or followed up with me. He and I ended up going with Sonny and whatnot, and just knocked the cover off the ball. But because I was telling the truth, I mean, my biggest thrill was the girlfriend I met, or the stock that doubled or tripled. But he didn't recruit me, so. Uh, and then Sonny finds him on a plane, and he says, "Oh shucks, I should have recruited. I should have followed up with that guy." So,
Now you said, sweetheart, you didn't meet your wife on the book field, did you?
no, I met her freshman year of college, and
Oh, okay.
just a good memory, and
Yeah.
yeah,
Well,
just one of those deals. But that was back when you're young and in love, and you can get in love over anything.
yeah, yeah,
Then all of a sudden you get married, and the tune changes.
yeah, real easy when you're in college. Matter of fact, my youngest daughter brought her boyfriend by last night. Said he wanted to meet us. I was like, well, that's a good kid. At least he came and stuck his hand out, shook my hand, and wanted to meet us. So that was
Exactly.
good.
Yeah.
But yeah, those college days were fun. Tell us a little backstory. How in the world did you transition into the financial services business from selling books or being a college kid?
Um, so my last year selling books, I just recruited, and I got a job with an international firm that had about 6 million of sales. And again, this is 40 plus years ago.
Yeah.
And I did cash management. I had 300 bank accounts around the world. I would do foreign
Wow.
exchange and move money around and that kind of stuff. I was just one of the guys in treasury. And it was almost natural because it felt with, you know, fit my degree. Um, but I always had a little college. I was licensed as a college agent back in that point in time, and some of my good buddies would have excess money, and they'd put $20 a month into some of these investment life insurance plans.
Yeah.
And lo and behold, I decided it was probably better to transition to a full time to become a financial rep, because I was making more money selling insurance part time than I was managing several billion dollars.
Really?
And yeah, and so it was a fairly easy transition. And Northwestern Mutual's got some sort of award, college agent. I won some award because anyway, just I sold a lot of life insurance that year too. My first full year of life insurance. So
Yeah. Well, that's pretty amazing. Yeah, I read over $1 billion under management.
yep, yep.
That's crazy. I wanted to kind of go back here to your bio a little bit. I skipped over this. I meant to say it. So you have your own company now, Bankers Benefits, and you're the president, the founder.
Right.
But you have a lot of initials, right? So you hold a BBA in finance.
Yep.
You have an emphasis on investments. You have a master's in financial services and
Right.
retirement planning. You're a chartered life underwriter, CLU, a chartered financial consultant, CHFC, from the
Yep.
American College, and you also have ASPA QPA
Mhm.
actuarial designation. So and that's from the American Society of Pension Actuaries. So you study
Mhm.
numbers, but I mean, my goodness, I mean, out of all those initials, Tom, tell us. Well, I mean, which ones are you the most proud of? I mean, because goodness
Oh.
gracious, you've got a lot.
The QPA was probably the toughest. The one that I probably appreciated most, and I taught these courses for a long time, was the Chartered Financial Services, kind of like the CFP of financial planning. So those were, probably the two that I appreciated the most. Um, so spent a little bit of time transitioning. Had a pretty good pension practice. But the big part of pension plans discriminate against the highly compensated. So if you were to do it, and pension plans, profit sharing 401k plans are all qualified plans.
Right.
But the money and the opportunity, particularly for the executive population, is to do the non-qualified plans where you can define, you're not following, you can define your own rules, who's going to participate, what they're going to get, etc. So the real opportunity was transitioning to non-qualified plans. And I did that, and I put plans in over the years for Procter and Gamble, United Healthcare, Caterpillar Tractor. Those are the ones, General Motors. Those are the ones in the Dow Jones averages that I put plans in for. But probably about 1993, 94, I decided just to specialize with financial institutions, banks. And we did $1 billion deal with Wells Fargo. Uh, but I specialized with banks in the mid 90s. And the reason, and I chose small banks, and it was, gosh, why sell a $1 million investment here when you can do $1 billion there? Um, but during the pandemic, it's an example. I'm driving out to West Texas, and the hotel calls me and said they're closing due to the pandemic COVID deal. And I'm calling my banks, telling them I'm going to have to cancel. And the banks are saying, no, you're not. You're going to be staying at my room, my house. You come by my house. Because at that level, the community banks are really friends. And, all the formalities were not there. Where in the big corporation, it was really a sterile sale. It was, uh, it just didn't have the personal engagement that the community banks had. So that was my transition, and I've been specializing with small community banks now for well over 20, almost 30 years.
So your company is Bankers Benefits.
Yeah.
Bankersbenefits.com is the website. But so that transition there, going from the book field to the life insurance, financial services business, and then graduating, to the banks.
Mhm.
So working, with banks. So I get, you know, I was just earlier today. And we're on at 5 o'clock, but there's bankers hours, right? So was that
Yeah.
a part of the reason for that? To get in to see the bankers on their hours and have some
Uh,
hours. It's always been a joke. Uh,
no, bankers actually work pretty hard. They quit seeing customers at a particular point in time, but they're still back pushing the pencil in the back office.
right.
Um, the um, the main reason for banks, it was as much an investment sale where they have a cost of funds, and the insurance has a, state return, and it was a fairly easy transition to educate how you can increase the bank's income by arbitraging what their cost of funds were versus what an insurance company would credit. So that was one aspect of that. It was just But it became greater than that, because every business, this is what I learned at Procter and Gamble and General Motors and United Healthcare. Every business wants to retain the people that really make it successful. So there's a group of people that you can't afford to lose, and a group of people you really want to keep. And it's usually about 10-20% of your population, and probably about 80 or 90% of your executive talent. And so we design plans to retain people. And the second thing that we could do, we could have it incentive based. And if you get the football down the field, can you give them an additional benefit? And what should that benefit be? And do you give it cash immediately, or do you give them cash over a period of time? So that's what we would also do, is not only sell the insurance as an investment, but we would also design plans to attract and retain the people you can't afford to lose.
Yeah. So it's funny, hearing you say that, the insurance as an investment, because nowadays that's kind of taboo, right? Compliance doesn't like us to use that word, investment.
Well,
Uh,
strike what I said,
yeah.
because I'm probably in trouble with compliance today.
Yeah.
Uh,
Well, hey, we might dig that hole a little deeper. We'll move on though. But look. So talking about compensation and packages, because that's really what attracts people to jobs, right? They want to know, well, hey, what, especially these days, if maybe it wasn't so much back then. Of course, they had pensions. Nowadays, pensions are kind of gone by the wayside. So employees want to know, well, do you have a 401k plan? Do you have a health plan? Do you have life insurance? Do you have disability insurance? All of these things, which you were able to offer. And, so you not only did BOLI, bank on life insurance, but you also did, or I don't know if you still do, COLI, corporate on life insurance as well. And a lot of folks, I don't think they quite understand, how much banks own of these things. So, and by the way, have you heard of Bunker Hunt? You ever heard of him?
Silver Crisis 1970, 79.
Yeah. Yeah. Okay. So they
It's
ask him why he robbed banks, right?
not Bunker Hunt. I mean, his brother owns the Kansas City Chiefs.
Oh, okay.
That's Nelson Bunker Hunt.
Okay.
Uh,
But he
and
was now I've heard of the silver stuff too. But who was the guy that robbed the banks? They said, well, that's where they keep the money. I was thinking
Well,
that was Bunker.
that's Dillinger, and his hometown was out of central Indiana. I actually went to that town with Dillinger, calling on banks at one point in time. Little
Uh,
central Indiana town.
Yeah, boy, you know some history. That's why I'm talking to you here. And of course, I might mix some of that stuff up. But back to working with the banks. I thought maybe I was trying to make a joke why you got started with them, because that's where they keep the money. But obviously, banks have a lot of money on deposit. And a lot of people, think they keep it all in the vault, or maybe it's backed by gold at Fort Knox. But tell us, I mean, what exactly is bank on life insurance, and how do banks use it?
Okay. A bank is capitalized with about 10% of the total assets being capital. That's what the shareholders put in. And the other 90% is deposits, CDs, checking accounts, that type of stuff, or money that they might have borrowed from a third party. So they're operating with about 10% capital. Checking accounts outside of the service cost is basically free money. CDs you obviously have to pay for. And they will take that money and then they will invest it in loans back to the community. And then they will put a portion of it, they have to have a portion of it in investments. So they'll buy treasury bonds, muni bonds, that type of stuff. So generally, they will loan out of all these deposits about 80% to the community.
Hmm.
The drugstores inventory, the car dealers inventory, um, the rental houses that some guy's trying to buy. That's where they effectively loan it out. and they have to loan it out at a rate above what their cost of funds are, whatever those CDs and checking accounts are. And then there's a margin that they have to have for loan losses. Loan losses do occur. They have to put reserves aside for estimated loan losses. So that difference is what they call the net interest margin, what you're paying for your funds and what you can get them back out. And so that net interest margin is what they work off of. And a bank is usually trying to get 3 to 4% net interest margins. So they're not making a ton of money, but they pick up 3%, 4% if they're lucky on the difference between their cost of funds and how they loan them out. So life insurance fits into that because in many, many years, the return on life insurance, this is just the cash value, not any death benefits. The cash value can earn in excess of what they can get on alternative investments. Today, the 10-year treasury is paying 4.25, and you can get 5% on life insurance. The life insurance has tax benefits. So to a bank that pays taxes, gosh, that's 7 or 8%. Effectively, they have a very good asset that's paying 7% when the Treasury is only paying 4. So it's a little bit of arbitrage. It's a way for them to diversify from their normal income stream, loans and investments and bonds, and that's where the juice is. They can make a nice, attractive rate of return. The second part to that, though, is loans have losses that can occur. Bonds have market fluctuation. The price of those bonds go up, down, and south each and every day. The cash value that they own is stable and steady. It's a stable value fund. It's not fluctuating with the market. You're getting accrediting rates. So if you put $1 in it, at the end of the day, you have $1 plus 1 day of interest. And the agreement is if the bank needs the money at the end of the day, the insurance company has got to send them that $1 plus that day of interest. So when you look at it, it has better risk characteristics than the investments that they can put in, and it's got a return that is equal to or better than many of the things the bank can invest in.
So it's less risky, it gets returns, got tax advantages, and they buy it on executives, VPs, vice presidents. How many VPs does the average bank have?
Oh, it all depends. It's across the board. But the community bank might have 50 employees. You've got 5 in senior management, the executive VPs, and then it probably has 15 additional officers that are controllers, cashiers, loan officers, that type of stuff. So typically, and a bank is heavily weighted to officers because all of these people have to be authorized to be able to do transactions. So in a bank, you might find 40%, 30 to 40% of the employees are actually officers.
Wow. That's a lot, though, 30 to 40%.
Yeah, but the insurance companies only want to insure basically your top 20 or 25%. So there's certain rules that an insurance company is looking at because they want to limit their pool of population of people they would insure.
Gotcha. So the VP scenario, I
Mhm.
guess. How often do they hire and need to purchase more of this stuff, or do they ever get multiple policies on one individual, or how often do people
Yeah.
come and go, invest and move, and you go back in and look at that?
So Barry, that's somewhat situational, but the general rule is when a bank does its investments, and you were looking at the interagency regulations. Remember, we mentioned that capital that's 10%.
You're right.
The
Is that tier one
interagency,
capital? Would that be
yes. Well, you can go down to tier 2 capital, but call it tier 1. All right. So they will allow you to invest up to 25% of your capital.
right?
But they want it diversified. They really want it spread between at least 2 carriers. Diversification seems to make sense. So the concentration with any one carrier is only 15% of capital. So if you have 10 million of capital, the most you can have with any one carrier is 15%. Now
Gotcha.
there's rules that are outside those rules, but that's kind of how that would fall into place. And and again, the insurance company only wants your highly compensated, and they have certain rules on how much they have to have in terms of salary before they'll be insured.
Are these more or less? Do they work like group plans, or are they individual? Each person individually underwritten?
You've got both options. When you have a group of 10 or more, you can get it guaranteed issue. Under a group of 10, you probably have simplified underwriting. And obviously, guaranteed issue is going to have a higher mortality cost than individually underwritten.
Right, right. So I was showing this slide here from the FDIC where they recommend bank-owned life insurance for risk management, BOLI, and I got that off the FDIC website a while ago. But lots of banks own life insurance, big ones, little ones. They own lots of it.
Mhm.
And you've been in the business for as long as anybody, it seems. So, what has been your experience with mortality? Do you, when you have a claim or they have a claim, you mentioned earlier it's just for the cash value, but the death benefit obviously can be large, right? So,
Yeah, here's got a couple scenarios, and then I'm going to go through kind of the inception of BOLI and how that got placed. But we frequently get claims. I've got one claim right now with a bank that did not want to buy BOLI. They didn't like BOLI. They just didn't feel like they needed to own BOLI because they might profit at somebody's death.
right.
But they acquired one of my banks that has BOLI, and this person had three policies with three carriers. So she had the three policies. The policies were earning about 4%, which to the bank was closer to 6.5%. So they had a very, very nice, attractive yield, better than what they could earn on loans, good loans, and more they can earn on their bond portfolio. Well, at the death, they're getting their cash value back, and that cash value is returned tax free. Plus, there's an additional 700,000 of death benefit that the bank is getting. And the president and chairman of this bank that didn't ever like life insurance, he says, "Hey, that's a hell of a deal. We're getting our money back tax free. The money was yielding more than we can get on our bond portfolio. Plus, I'm getting over 700,000 of death benefit gain." So that's kind of the nature of it.
It's kind of funny how that happens. The longer people, are around or own life insurance, the more they like it. We were talking a little before we got started, about, us individually owning policies and people owning more than one policy,
Mhm.
having different uses for them and the compounding, especially. So, lots of uses for individuals and obviously banks and corporations, but somehow people can't really wrap their arm around sometimes cash value life insurance. I guess
Mhm.
there's just so much negativity in the marketplace out there. People can get a higher return, right? Maybe in the stock market and taking risks. So I wanted to kind of touch on that. You mentioned back when you were in college, you started out doing a little investing and you did really
Yeah.
well. Well, I
Uh-huh.
too, when my second summer on the book field, roomed with a friend of mine who's still a good friend, a colleague. He's actually been in this business a while as well, but he was a young stockbroker, and moving forward, one summer I had saved quite a bit of money, and I put all of my money in a one stock that was out of Mississippi at that time. It was MCI. Do you remember them?
Last I checked, the guy's sitting in prison.
Yeah, exactly. And all of
And
my money, my entire summer's savings down the drain. It went
yep,
up initially, and I thought
yep,
I was on the moon. But that
yeah.
was
Well,
my
that was
first loss of money. Um,
that was the dot-com telecom bust of 1990-91. So
yes,
my
exactly.
condolences, and um, uh, I, I got some stories on that. But anyway, I thought the market was going to bust, and I'm out of town, and it's starting to fall apart. Everybody wants to go out to eat. I just sat there and watched the TV and let the market fall.
Yeah.
So
Well, that's interesting because you've been through quite a few. You've seen it from all different directions. You know, being
yeah.
in financial planning and working with pension plans and working with banks and corporations and the life insurance business. But there's one thing that's been steady through all of that, right? And that's life insurance because
Well,
most of it has guarantees. They don't like us to say that word either, but that that's something that I personally I've lost money in real estate, stock markets, you name it, business, but my life insurance has always been there.
and this is one of the values of life insurance that is underappreciated, and it's the reason why I own a significant amount of life insurance. Is it is always stable value, and it is always giving you an attractive rate of return, and the attractive rate of return is tax enhanced. So I loan it as collateral to the banks, or I don't have to loan it as collateral to the banks because the insurance company will allow me to withdraw it at any time. But I give it as collateral to the banks. So when opportunities come up, be it the divorce down the street, or we were talking about the dot-com bust or the oil bust in Houston, where I would take out that cash value and buy some rental homes. I mean, we're talking during the day, $150,000 homes that I was picking up for 30,000 because Houston was everybody was mailing. So anyway, opportunities come up without getting the specifics. Let's just say opportunities come up.
Right.
You can easily pull from that cash value and take advantage of opportunities. And then when you harvest your gain, you pay back your loan either to the bank or you pay it back to the insurance company, but you're always guaranteed stable value, and it's got an attractive rate of return while you're parking your money waiting for that next opportunity. So it's a beautiful thing. Plus, if something happens to me, there's life insurance over and above it. And that life insurance is what helps that investment to be tax free.
Absolutely. And you hit on two key terms there: collateral and loans. So banks like life insurance for that reason as well. I had a client actually call me just this morning, um,
Mhm.
looking to finance a business, um, and the bank was wanting to know about his life insurance and about assignments and things of that nature. And I had to share with him again how he can use that himself without turning it over to the banks. But banks like life insurance as collateral. It pretty much gives them and the life insurance companies work the same way. As a matter of fact, you can tell me, have you been to the home offices? I know you have to some of these big banks, but have you been to the home offices of some of the life insurance companies?
Absolutely. This is also one of my markets, but it's downsized where we work with other financial institutions like insurance companies, particularly property casualty companies.
Yeah.
So we have attraction and retention and incentive plans for them, but we're also using life insurance. I mean, all the property casualty companies in Illinois, the cash value on my life insurance exceeds the investments on their portfolio,
Right.
and so literally it's a no-brainer. But
Yes.
we work very closely with a lot of life insurance companies for benefit plans as well.
Right. And so, just going to show another mentor of mine here, Nelson Nash, who really taught me about this concept. Of course, that's Sam Moore. I think that's my first summer on the book field in the middle '80s,
Mhm.
and then that's later on in life. But Nelson would talk about similar to what you just said about loaning banks money and whatnot. He used to loan. Same thing. He had some clients that didn't really believe in life insurance. And he would talk about attorneys quite a bit and how and he was a pilot. He liked to
Uh-huh.
fly planes, but he would talk about loaning them money to purchase their planes, right? And so,
yeah.
uh, you know, banks love life insurance, and we do as well. But you talked a minute ago. You kind of just touched on, some of the debacle, some of the things that happened with banks, some bank failures, and the risks that they take, and
Mhm.
uh, so maybe tell me a little bit what's been your experience with banks and risk. If they get into a pickle, obviously there's a lot of news in recent years, especially this year, I guess, with some regional banks. But how does that affect you when things like that happen?
Um, that is such a broad subject. Let me just hit one topic that's current today. It's what's called AOCI,
Okay.
alternative other comprehensive income.
Okay.
So the banks have invested in bonds. The Fed raised interest rates dramatically, very, very quick.
Yep.
So the value of those bonds has gone down in value. Now, all these bonds are still performing, they're still paying, but a lot of the banks invested in bonds that were paying 1 and 2%. The next day, interest rates are up at 5%. Those bonds have fallen in value. So AOCI, alternative other comprehensive income.
Right.
So what effectively has taken place is that some banks actually have negative capital today when you mark their bonds to market.
Right.
So the beautiful thing about life insurance is the life insurance held steady, and it's really very accretive and popular for banks to have an asset that gives them a good interest rate, but is not having to be marked to market. So that's one of the issues, and that's what's happened to Signature Bank, Silicon Valley Bank, and some others, is that uh, they had all this cash on the books, and they went out and bought a bunch of bonds and only paid 1%. And the Fed raising interest rates from 1% to 5%, all those bonds showed big losses. And when that capital got low, the depositors said, "Hey, I'm not going to keep as much money in the bank. Let me move it out." But the value of life insurance is that it's always stable value.
Right. What are your thoughts on the Fed and them? Do you think they're going to raise rates again or lower them this year?
I think they ought to keep them just where it's at. The neutral cost of money is about 2.5 to 3%. You still have inflation. The fact that they got the Fed funds rate up at 5% says it's slowing the economy down a little bit. I think the Fed's just going to keep money exactly, the price of money exactly where it's at. What happened was moral hazard, because when you priced money at zero, there was no real cost to anybody when they borrowed money. And so they did a lot of dumb deals, stupid deals. And when there's no price to money, again, you just do a ton of stupid deals. Now that we have some price to money, you're going to find that money is only going to be used for productive investments that meet a hurdle rate. And that hurdle rate has to be more than they borrow, the cost of borrowing. And the cost of borrowing is at least 5% because that's where Fed funds are today.
Yeah, I agree. Most people they quickly forget what rates were like in the 70s and 80s, right? I mean, uh,
I had a
so
13% mortgage. I had
yeah,
a 13% mortgage.
yeah. Many people did. Um, so talking about the banks again, and you kind of touched on bonds and whatnot, but there's a lot of new money out there. Let's
Mhm.
call it. What do you think of this digital dollar idea and the Feds getting involved with crypto and whatnot?
Um, when the government is not your friend, and when the government debases their currency, spending too much, um, and misappropriating money, and when you misappropriate money, who wants to invest in that currency? So we've always been the store of value. And as they misappropriate and misallocate money, it says the value is effectively going to decrease. So traditionally, the alternative investment or money has been gold. For thousands of years, gold's been the alternative, and silver's been the poor man's gold. The digital currency is still trying to evolve, but basically, it's a electronic version of what gold is.
Right.
So if they continue to debase our dollar and not treat us fairly, and this gets back to debt to GDP, budget deficits, et cetera, how much you owe versus what you own, and this is the government, being out of balance. You're going to find alternative forms of money doing well: silver, gold, and digital.
Yeah, it's amazing how much crypto it just experienced a growth over the past year or so. But I think a lot of people are concerned with the fact that the Fed, this Fed now and whatnot. So I didn't know what you might think about that in the future. But I noticed regulation, and on your website you talk about the different regulations. And so going back to Tefra and DEFRA, which is
Mm-hmm.
where they created the MEC for life insurance back
Mm-hmm.
70s and 80s, whenever people were putting a lot of their money into life insurance to avoid paying taxes.
Mm-hmm.
So and you brought, the reason I brought this photo back up is because you brought up about the government getting involved, and so the famous quote by Ronald Reagan, what did he say?
I'm almost scared to guess. The government is here to help.
Yeah, the government is here to help. So
The scariest words. What was
yeah,
it? 5 words. The
yeah,
government is here to help.
yeah. So do you think the Secure Act does it mean what it says, secure? Are we
Uh,
more secure having this act?
all those are misdirections, because at the end of the day, what you have is every budget, family budget, government budget, business budget, you have to be in balance, and we are so far out of balance. There's a book written by Rogoff that came out during the 2007 financial crisis, and it basically says that when you get your debt at 100% of GDP, when you're over that, you're going to be in perpetual slow motion. You're not going to grow. It's very, very painful to get out of, and you got a high risk of bankruptcy. So right now, with 35 trillion of debt and 30 trillion of GDP, you're sitting at over 100, almost 120% negative ratio. And those are ratios that, if you look at historically, has led to other companies to default. And it's a fantastic book. But that's their study. And Rogoff right now, I think, is he was Harvard, and now he's chief economist at Morgan Stanley. So it's a good book to go back and review. But we
And
cannot continue. We cannot continue to piss money away, because what we're doing is denying those that are working today. We're denying those that are working and paying. We're denying them benefits.
yes, the spending is out of control for sure. When we're having to borrow to spend, it's just backwards.
Well,
Uh,
the second part to that, Barry, is if you spend and it goes to an investment, you have something firm and hard like a bridge or a tollway or something that is a capitalized asset that you can get back. But when you're just doing it and spending your money on potato chips and transfer of wealth, and there's no return on that investment,
not
it leads to major problems.
Yeah, I think people, when you pay taxes, like I said, you work hard and you realize that we're spending more on the interest on the debt
Mhm.
than we are pretty much anything. $1 trillion
Yep.
every 90 days are spending. It's
Yeah.
just insane, and all the money. But moving on, and just kind of to close out here, what do you think the general public, the average family that's not an executive at a bank or a big corporation, what do they need to know about banks, lending, and life insurance? How can they possibly, do what the banks do?
To the ordinary family, your money in the bank is safe, and it is a good spot to park money, particularly for short-term liquidity needs. But it doesn't hurt to build up long-term assets, and life insurance is a very significant long-term asset because it compounds uninterruptedly. It compounds and will continue to grow. And if you ever need it, you can pull it back in for whatever emergency purposes that you might require. What the theme of it would be is the ordinary family is how can you fit it into the budget? So you got to make something uh, flexible and easy and into the budget and make sure it doesn't affect the family's root beer drinking money. Your wine money, my beer drinking money, but the typical family's root beer drinking money. So it's got to be something that's comfortable and fungible. That's number one. Number two is you ought to do it early in life, even before you get, the family. I mean, a single person ought to be buying it as much as a married person. Uh, before you have 2.2 kids and a mortgage and all the college education funding and trying to keep the kids in clothes, it doesn't hurt to start off doing it early. I mean, I got some policies that I bought back in college, $15 a month, that have almost 100,000 of cash value today.
It's amazing.
And who needed, I didn't need any insurance in college, but 15, 20, $40 a month, and all of a sudden, well, it's six figures of cash value.
Absolutely.
But I'm
Absolutely.
not going to say my age, but I just had a birthday
I
not
know
too
you
long
just had a
ago.
birthday, and I got one coming up. So yeah, we'll stay away
Yeah,
from that topic. But
exactly.
yeah.
So
So
a lot of years of uninterrupted compounding is one of the best things that could ever happen.
absolutely. So I know you told me for your birthday you just got back from a little vacation with the family.
Hmm.
So tell me what's really important to you for your legacy and uh, your heirs. What's the main thing that you want people to know about Tom Kosanda and uh, how you want your family to think about you?
Barry, you might have stumped me on that one. Uh, Invite me back. We're going to talk about incentive comp and retention plans and whatnot. We'll have a discussion, and I will think about that to come back up.
Well,
Uh,
it's a
but
tough one,
basically,
but
but basically, that you know, Tom's worked hard. He's had good values. His heart's been in the right place, and a little bit of the TV series I watched as a kid, Superman, Truth, Justice, and the American Way.
well, I know you
So
took him on a vacation, and I try to do that with my kids and just let them experience the world. And you told me a little bit about some charity that you were doing as well. So kudos to you for that. And I really appreciate you coming on with us today. Is there anything else that you'd like to share with the audience before we leave?
well, we're going to come back at a later date and we're going to talk about incentive plans, retention plans, and all kinds of
Incentive.
yeah, supplemental executive benefits and synthetic stock and stock appreciation rights. There's all kinds of fun stuff that we're going to talk about at a later date. Uh,
Fantastic.
but you're doing the Lord's work here, educating people and setting them in the financial motion to be better for them and better for their families.
Well, thank you so much for joining us, Tom, and sharing your story. And just want to remind y'all out there, thank you for watching. And if you give us a thumbs up or subscribe at Legacy Money, we'd appreciate it. And if I can help you any way, just let me know. There's my website, legacyinsuranceagency.com. So thanks again for joining us. Take care, Tom. Appreciate all you've done. All right. See
Appreciate
y'all
you,
later.
Barry.
Thank you.
Okay,
Bye
bye
bye.
now.